Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hello friends, this is Vijay Bhambwani and I hope my videos are helping you understand the intricacies of the market better and they're improving your trading and investment process. Today I want to talk to you about what you can do to profit from falling oil prices even if you're not a commodities trader. So, you see friends, markets are interrelated. Recently in my video about what will happen if the RBI was to raise interest rates, I gave you an analogy of the Titanic, how the engineers who built the Titanic based it on a faulty assumption that you could build solid steel doors which would basically block out the water from any leakage in the hull. So you see, money I gave you in that analogy is like water. It flows from one compartment to the other even if you try to put obstructions in its way. And all the markets are interrelated. So there is a pull and push for commodities on equities, equities on Forex on the bond markets on commodities, and vice versa. The permutation and combinations are endless. All the markets are married to each other and therefore you need not actually play all four markets or all four asset classes. Now, I'm going to tell you how falling oil prices will benefit a particular sector or a few sectors as a matter of fact, and how you as a stock investor can grab the opportunity by the horns. You see, the premise of any business is built on a very simple foundation stone. Buy low and sell high. That's how profits are made, at least in the manufacturing space. It's only in trading the equity markets that you can actually make money even in falling prices. We are now currently focused only on corporate profitability. So here you have to buy low and sell at a higher price. And when your price, the selling price is fixed, but your raw material price comes down, that results in a windfall gain for any company, and that not just gives the company bread and butter, but also gives it jam and chocolates. Markets realize that because markets have a very smart and sensitive nose for profits. It bids up the prices in that sector in anticipation of higher prices. So you've seen crude oil fall more than 20% from its recent peak. As per the classic Dow theory, any price that falls 20% from its peak is said to be at least in a short-term bear market, if not in a bear market. Chances are that oil prices might fall further. What if they do? Which sector gains? Any sector that uses oil or derivatives of the oil industry, petrochemicals, etc., will be a direct beneficiary because it will see its raw material prices come down over a period of time. What sectors are these? Any company that makes epoxy-based resins, adhesives, they are very heavily dependent on petchem or petrochemicals. So their raw material price will fall very, very sharply. As a matter of fact, raw material prices have fallen because you can see crude oil, I'm talking of WTI now, Western Texas Intermediate, has fallen from approximately $130 a barrel to sub $100 a barrel. The second sector that is likely to gain is plastics and polymers. Now here again, this is a sector that uses petrochemicals and oil-based derivatives as its raw material, and their raw material prices will also fall fairly sharply. So here again, here is another sector that's likely to make above average profits if oil prices continue to fall. Third sector, oil-based paint and dye companies. You see, there are some companies that are diversifying from oil-based paints to water-based colors. Those are apart. I'm purely talking about oil-based paints because the dye that makes the paint, oil-based paint, is a pure petrochemicals derivative. So here again, this is another sector that will have a direct gain to the bottom line because the selling price is fixed but the raw material price is falling. Therefore, the sector will start making above average profits. These are three primary sectors which I have seen in my trading career, and I've been trading these markets since 1986. These are three sectors which I've seen are extremely sensitive and are the first to react to rising or falling oil prices. There are of course others, but these three have a very tight correlation with oil prices. So I think when oil prices stay below the $100 mark, I'm talking about Western Texas Intermediate or WTI, these are sectors that you should be keeping your ears to the ground for as investment buying on the dips. On this opportunistic and very cheerful note, I'll bid goodbye to you, not before reminding you to click like on this video if you liked what you saw, and subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up here. Good, bad or ugly, I always welcome your feedback in the comment section and help me reach out to fellow like-minded investors and traders by referring my videos to your family and friends. I thank you for your patience in watching my video. Till we meet again in my next. This is Vijay Bhambwani signing off for now. I wish you have a very, very profitable day. Take care. Bye-bye.